This is not a cooling market. This is not a return to normal. This is not relief for tenants. This is the UK rental market breaking its own rules. For the first time in modern British housing history, we are witnessing something that should not be happening under classical economics. Tenant demand is falling. Landlords are still leaving. Supply is still shrinking at the same time. And that combination is profoundly dangerous. Because when demand falls, markets are supposed to stabilize. When competition cools, prices are supposed to ease. When pressure releases, balance is supposed to return. But that is not what is happening here. The UK rental market has flipped, and this flip marks the beginning of a far more unstable phase of the housing crisis. Today, I'm going to walk you through the data that proves it, the structural forces driving it, and why this moment should worry every tenant, every landlord, and every policymaker in Britain. And before we go any further, if you care about understanding what's really happening in UK housing, not the headlines, not the spin, please take 1 second to like this video and subscribe to the UK Property Report. It tells YouTube this analysis matters, and it ensures you don't miss what's coming next, because this story is only just beginning. Now, let's begin with the flip itself. For the last 3 years, the UK rental market followed a brutally simple pattern: exploding demand, collapsing supply. According to Rightmove, Zoopla, and the Office for National Statistics, tenant demand surged after the pandemic as immigration rebounded, household formation accelerated, first-time buyers were locked out by mortgage costs, and social housing waiting lists ballooned. The result was properties receiving dozens of inquiries within hours, tenants offering 6 to 12 months of rent up front, and rents rising 30 to 50% in just 3 years in many regions. This channel has documented that phase extensively, but over the last few months, the data has shifted sharply. According to Rightmove's most recent rental market updates, tenant inquiries per listing are now materially lower than last year, particularly in London and the South East. Agents are reporting fewer viewing requests, longer listing times, and less frantic competition. Properties that would have been taken the same day are now sitting for weeks. On the surface, that sounds like good news, but here's the problem. Landlords are still leaving the market faster than before. According to UK finance and HMRC transaction data, buy-to-let sales and landlord exits have increased year on year, even as demand cools. This is the paradox. Demand is falling, supply is still contracting. That is not how a functioning market behaves. Let's put real figures around this. According to Rightmove's rental index, tenant demand is down around 20 to 25% year on year in several regions. London has seen some of the steepest declines. The South East and commuter belt are following close behind. At the same time, landlord listings remain well below pre-pandemic levels. The number of rental homes available is still over 30% lower than 2019. Buy-to-let mortgage lending is at historic lows. Even more striking, landlords are exiting now at a faster rate than when demand was at its absolute peak. That tells us something critical. Landlords are not responding to demand conditions anymore. They are responding to structural pressure, and that changes everything.
To understand why demand has dropped, we need to be very precise. This is not because people suddenly don't need homes. Britain did not suddenly gain millions of spare bedrooms. What we are seeing is demand destruction caused by affordability collapse. Rents have risen 35 to 40% nationally since 2021. In London, many boroughs have seen 50% or more increases. Wages have not remotely kept pace. The result is the average private renter now spending 40 to 45% of gross income on rent nationally, and over 50% in London. That is well beyond internationally recognized affordability thresholds. At that level, demand does not cool, it breaks. People don't choose to exit the market, they are forced out. This demand destruction is showing up in very specific, measurable ways. According to household data, multi-generational households are rising. Young professionals are reversing independence. Rent is no longer compatible with basic living costs. This removes demand from the market, but not because housing need disappears. It's because housing becomes unaffordable. Single occupancy renting is collapsing. People who would once rent alone are now sharing with friends, doubling up with colleagues, or taking rooms instead of flats. That reduces the number of rental units demanded, even though population and need remain unchanged. Workers are leaving high-cost regions. Some are leaving the UK entirely. Others are commuting unsustainable distances. This is not reduced housing need. This is economic exclusion.
Here is the critical point. Nothing that caused landlords to leave has improved. Not one thing. Interest rates have destroyed buy-to-let maths. A landlord who fixed at 2% in 2021 is now refinancing at 5.5% or 6%. On a £200,000 interest-only mortgage, monthly interest has jumped from roughly £300 to nearly £1,000. That's an extra £8,000 per year. Even after rent increases, many landlords are now cash flow negative. Section 24 is now fully in force. Landlords can no longer deduct mortgage interest before tax. Instead, they receive a basic rate tax credit. A landlord earning £18,000 in rent and paying £12,000 in interest is taxed on £18,000, not £6,000. In many cases, the effective tax rate exceeds 100% of real profit. This is not opinion, this is arithmetic, and falling demand does nothing to fix it. Regulatory risk is accelerating exits. The Renters Reform Bill, EPC upgrades, licensing schemes, safety compliance, and eviction uncertainty are stacking simultaneously. Many landlords are exiting preemptively, not waiting to see how reforms play out, choosing certainty over risk. Again, demand conditions do not change this decision. A loss-making, high-risk investment does not become viable just because there are fewer tenant inquiries.
In a normal market, falling demand leads to falling prices. Falling prices lead to supply stabilizing and balance returns. But the UK rental market has lost that mechanism. Because landlords are not exiting due to weak demand, they are exiting due to structural policy and financial pressure. That means supply continues shrinking regardless of demand, prices remain supported by scarcity, and pressure rebuilds beneath the surface. London has seen the sharpest demand drops. Rents now average over £2,000 per month. That represents more than 50% of income for median earners. Yet landlord exits are accelerating, not slowing. The South East tells a similar story. Pandemic rent surges are now reversing demand, but yields remain stretched and landlords are still selling. The Midlands and the North show demand holding up better, but yield compression and refinancing shock are still driving exits. Scotland and Wales add rent controls, licensing regimes, and further uncertainty. The pattern is national. Demand destruction creates temporary calm. Supply destruction creates future explosions. When demand stabilizes, it will collide with a much smaller rental stock. That means another rent surge, even harsher competition, and more people locked out. This is not speculation, it is structural inevitability.
Now we reach the most dangerous implication of all. Demand destruction creates the illusion of relief, but supply destruction creates delayed explosions. Demand always returns because population grows, households form, immigration continues, and economic conditions stabilize. People do not stop needing homes, they just postpone it. When that demand returns, it will hit a smaller rental base. This is why rents are not falling. Rents are not set by demand alone, they are set by scarcity. Scarcity in the UK rental market is still intensifying. Even after the recent demand pullback, there are still more tenants than homes in most areas. What is changed is not the balance. What is changed is the margin.
Of a company
a landlord does not cut rent because demand falls from insane to very strong. They cut rent when properties sit empty with no viable applicants. That is not happening at scale. The floor under rents is structural, not market-based. Rents are no longer anchored to what tenants want to pay. They are anchored to what landlords must charge to survive. A landlord refinancing at 6% with higher maintenance, insurance, compliance costs, and full Section 24 taxation cannot reduce rent even if demand weakens. If they do, the property becomes a guaranteed loss, and when landlords face guaranteed losses, they don't discount, they exit. Periods of slowing demand actually increase landlord exits. When demand was frantic, landlords told themselves rents would keep rising and competition would protect them. But when demand cools and losses remain, the illusion breaks. This is capitulation, not correction. Build to rent will not save this market. It represents less than 2% of total rental stock, and even optimistic projections barely reach 3% over the next decade. Institutional investors only want large city centre blocks. They do not want suburban family homes, market town terraces or former council properties. Those are exactly the homes individual landlords provided. When those landlords sell, those homes move into owner occupation permanently. Build to rent does not lower rents. It often raises them. It targets higher income tenants and operates as a parallel premium market. Policymakers are misreading the data. Falling inquiry numbers create false reassurance. The Renters Reform Bill focuses on tenancy security but does nothing to increase supply. Tax policy treats landlords as revenue targets rather than housing providers. Planning remains choked. There is no pipeline capable of replacing lost rental stock. For tenants, falling demand does not mean easy renting. It means slightly less frantic competition, but still severe scarcity and rising long-term risk. If you have a stable tenancy, protect it. If you are searching, prepare for documentation arms races and tough referencing. Flexibility matters more than ever.
For landlords, realism is required. Highly leveraged landlords will not be saved by falling demand. Structural costs remain. Exit may be rational. Low-leveraged landlords with genuine cash flow may survive and even strengthen as competition leaves, but the bar is higher than ever. This is no longer just a housing story, it is an economic one. Workers cannot live where jobs are, cities hollow out, family formation collapses, inequality deepens, housing becomes inheritance-based. That is not a healthy society. The solutions are not mysterious. Tax neutrality, massive social housing investment, planning reform and policy honesty are required. You cannot punish supply and expect abundance. That fantasy has failed. The UK rental market has not healed, it has fractured. Demand has not cooled naturally, it has been crushed by unaffordability. Supply has not stabilised, it is still bleeding out. This flip marks the end of the old narrative and the beginning of a far more volatile era. If you found this analysis valuable, subscribe to UK Property Report and turn on notifications. Share this video with tenants, landlords, and anyone who cares about Britain's housing system. Leave your experience in the comments. The flip has happened. What comes next depends on whether we finally face reality.